Hi, Dom, and thanks for joining us again for a quick little rundown of some of the stuff that you've been looking at recently in the US, and also sort of your outlook for the near term in the week ahead.
Hi, Henry. It's nice to talk to you.
Thanks. Thanks for wanting to. So yeah, and I mean, I think it's been a very interesting week. Obviously, market's always moving. A lot of stuff that we've been putting out on that topic. But you've put out a couple of, I think, really interesting pieces of late just in the last week. Particularly one on sort of looking at how much steam is left in the US, the current US expansion. Could you just give us sort of maybe a quick rundown on your thoughts on that, particularly given that we've just had the Atlanta Q1 GDP estimate last week?
So yeah, I mean, if you look at the expansion, it's only 3 years old compared with the pre-pandemic expansions that lasted 12 years. So that would make you think, wow, we still have ways to go. Actually, maybe not, because if you look at unemployment, it's below 4%. And that happened only twice before, I mean, since the 1960s. Once was before the pandemic, and we'll never know whether the inflation was headed for overheating or not. And the previous time was in the mid 1960s, and then in 1966 to be precise. And then 4 years later, the US entered a recession due to inflation and of course Fed tightening. Now, I think this time is different, that we won't get inflation. We'll continue to get disinflation. We can, talk about it in the context of the PC print next week. So this time will be different, but looking at the historical precedent made me think, and I'm certainly monitoring the economy for signs of overheating, which I'm not seeing at the moment.
And you've also put out a piece recently on the disinflation front, the fact that even pretty strong fiscal spending you don't see as kind of offsetting that disinflation. Yeah, sorry.
Yeah, that we have disinflation despite a shocking budget deficit, essentially because the private sector, mainly businesses, are saving a lot. It's a profit. Look at the profit share. It's skyrocketing, but they are not investing that much. And that's offsetting the excess of public investment over public savings, which is what the budget deficit is. So if that changes, if we have a pickup in investment, yeah, there is a risk of overheating. Not seeing signs this is happening, but definitely something I'm watching closely.
Oh, awesome. And in terms of that, it's interesting you mentioned the profit shift. Is the Fed at all concerned? Because I know the Bank of England, ECB have been very sort of focused on, oh, is profit margin falling and that sort of offsetting some of the cost rises, and therefore a sign that companies aren't sort of passing on those rising costs to consumers. Is the Fed looking at it in a totally different way in terms of high profits being sort of?
Well, as far as I can tell, which is based on public communications, the Fed is not looking at it. And yes, it's a big difference, especially since inflation in the US was in a greater part than I think in Europe, the result of higher margins. But so far, the Fed is not focusing.
Okay, nice. And next week or this week we get the second reading of the Q4 GDP. Do you expect that to tell us much more, or is there anything that you're sort of looking out within that?
So the reading itself, not much more. It's probably going to be about where it was before, 3.3%. And one of the conditions for a cut, I think, is for GDP growth to move closer to trend of 2%. But for me, it's a profit. We will get the first estimate of Q4 corporate profits. And so it will be interesting, not just because this huge excess of profit over corporate savings. So business savings over business investment is one of the reasons I'm confident that disinflation will continue. But also in terms of downside risk, in every recession since the 1960s, we've had a sharp decline in real corporate profit per worker before the recession. So that's something I will also be monitoring closely.
Excellent. And we did get, I mean, in terms of, you mentioned in terms of what the Fed's looking at, we did get the Fed's minutes this last week. Was there anything particularly interesting in that, or?
Yeah, I thought it was more hawkish than the presser. There were comments about idiosyncratic factors driving inflation, more of a split between those who expected disinflation to continue, and those who saw a risk, more of a split than I thought, and in general, less confidence that disinflation will continue than, in my view, Powell conveyed at the presser.
That's very interesting. Definitely something to be sort of keeping on top of. So I would encourage everyone to sort of keep reading Dom's stuff on that front. And you've also been putting out a sort of a periodic election monitor, which is, I mean, even though it's a pretty decent time ahead of the election in the US now, you're already starting to see some pretty interesting things. So I mean, for background, this week's piece, Dom kind of looked at some of the betting probabilities around potentially. Is the market kind of moving towards potentially a different Democrat nominee than Biden? Would it be possible for you to just give us a quick rundown on some of the interesting things you found within that?
Sure. So I would say what's striking to me is that market interest, as you said, is unusually early. By comparison, the public doesn't seem that much interested. One of my charts is Google, the share of Google searches on Biden and Trump, which is well below the last election cycle. I also added Taylor Swift as a sort of a benchmark. And the public is definitely much more interested in Taylor Swift than either candidate. So to me, that suggests a risk of a low participation in November, which would be by contrast with participation in the previous presidential election that I think was one of the highest on record. And in terms of risk of a change of candidate, yeah, they are unusual, possibly because of the age of both candidates. And one way of measuring this risk is to look at the difference in betting odds of the White House becoming Democratic or Republican, and the odds of Biden or Trump winning. And the widening, I mean, the difference between White House and Biden odds has been widening, which I think probably has to do with the public prosecutor on the Biden document case making some comments about President Biden's memory or lack.
Absolutely.
Yeah.
Yeah. And we'll have I mean, you sort of mentioned the sort of the troubles facing Biden, but we've got the Michigan primary coming up this week for Democrats. Is there much that's going to sort of be taken from that, or what are people going to be watching for really on that front?
So Michigan is a swing state, and it's hard to imagine either candidate winning without winning Michigan. And Michigan is also home to a large Arab American population who are rather unhappy at the administration current Middle Eastern policies. And we will get a sense of how they react by looking at the results of the primaries, perhaps not so much in terms of candidates win, of delegates win, because we have only three candidates: President Biden, Representative Phillips, and Williamson, who is a writer. And Williamson and Phillips are not that well known. So what will be more interesting will be the participation in the primaries, and also maybe the share of votes, blank votes or null votes, rather than the share of votes going to either Phillips or Williamson. So that should be an interesting Tuesday.
No, absolutely. And I mean, just in general, when sort of watching elections and stuff, when the turnout rate becomes the most important factor, it just adds a lot of volatility and a lot of sort of uncertainty, especially sort of when you've got first past the post system and just winning a few states like the swing states can really shift sort of house stuff. So definitely seen that in other countries already. So very interesting to kind of watch that ahead in the US. So just wanted to check, is there anything else that's sort of interest this week, do you think, that you're watching?
So a ton of data besides GDP, which we discussed already. The PCs, I mean, we already know it's going to be bad, about 40 basis point. Core, super core PC, perhaps about 60 basis points. To me, it's more a bump on the road. My core view continues to be disinflation, but disinflation at a slower pace than the previous 2 years, because we are on the famous central bankers last mile. Other than that, personal income and spending, which as always is key because consumption is 70% of the US economy. I'm looking for the savings rate to increase a bit, because I think the decline in the savings rate reflects a combination of inflation, surprise decline in real income, real wages. And with real wages perking up, I think inflation has a good chance of normalizing. We'll see that. Then we will get a slew of manufacturing PMI. To be honest, manufacturing is only about 10% of the US economy. So these are more interesting because of their relationship with the services PMI. So we'll see, but I'm not expecting much new news and exciting developments. Then we also get real estate data, construction data. On the residential side, new home sales, not much going on, and I mean a bit of a recovery here. Construction spending, the non-residential construction will be interesting because we have this boom in non-residential construction. Jobless claim, I mean, same old, flat and showing, tight labor market. So yeah, that's about it for next week.
That's a pretty decent slew, as you say. And yeah, it is an interesting point you've made in terms of the consumer spending and savings rate, because the US has been quite different from elsewhere in terms of really running down savings rates. I mean, for the UK, for instance, it's basically shot back up. So reading into what you have to sort of say and what post that will be very interesting, I'm sure. So as always, I'd like to sort of flag a couple of the pieces. Obviously, we've run through a couple of Dom's pieces, so I'd definitely recommend taking a look at her piece on the election and also a piece on the how much is left of US growth and how sort of far we are through the cycle, I suppose. We've also got Bilal's put out his podcast with Claudia Sarm of the Sarm Rule fame. So that's obviously very interesting and very sort of apt for these times. And then we've also put out an updated view of European bond supply as well for our pro clients. So anyone who's interested to take a look at that and sort of read about the recent downgrades of growth in France and German growth, please feel free. So as ever, thank you so much, Dom, for joining us once again.
Thank you, Henry, and have a nice weekend, everybody. Next week it's going to be busy.
Absolutely, as ever. And please join us again and do drop us a line if you've got any questions about any of this stuff.